So today, I have a very, very exciting story to share. And that's part of the giving back is the folks that have stepped up within Lifestyles and done something. And in this case here, they've done a full exit. So these are not projections. These are not estimates. Those are okay. There's nothing wrong with that. When we come up and present projections and estimates, what I really love is when someone has done full circle. They bought it and they sold it. So that's what you get to hear today is someone who bought it and sold it, right? And the other thing I like about today's story, not to give away too much before I introduce him, is it's not like he bought it in 2010. You're like, oh man, if I had joined in 2010, of course I would have these double-digit returns, right? No, this guy bought it less than 2 years ago. And if you think back what was going on less than 2 years ago, he bought it in the middle or in the deep part, right, of COVID, of lockdown, right? So it's like here we have a good story, bought it less than 2 years ago, and he's going to share with you from beginning to end what happened. So without further ado, let me introduce you to Scott Mackey. Big hand. All right.
Thanks, Curtis.
All right.
How y'all doing tonight?
Oh,
doing
sorry.
good?
I didn't realize we had presentations on the team.
Yeah, you're supposed to say you work with other people, too.
I did.
You did your speech.
And I did the operations consultants, but I didn't realize we had photos, so.
No, we came for the Curtis.
Yeah. I came for the Scott.
All right, so a little bit about me. I'm married. My wife, Melina, in the picture on the left, that's us and our 3 kids at Stingery and Bolivar. Many of you probably know that. We've got 3 crazy boys that keep us busy a lot. So it takes up a lot of our time. So we love them to death.
So why did you join Lifestyles?
Well, so my story starts many years ago when I was working at a bank. I worked for several banks over the last 20 years, and I went through a layoff in late 2016, and there was a period of about 9 months when when I first got laid off, I was just I felt lost. I didn't know what I was going to do. Like all I'd ever known was like W-2, corporate job, go work real hard, and just fully fund your IRA and your 401k, and wake up 30 years later and everything's going to be fine. You can retire great. Well, I got laid off. Didn't have an income, and my wife also worked in corporate America. And in 2016, we were both in oil and gas finance. It was kind of a precarious time. So I was out of a job. Her job, it wasn't 100%. So we were thinking, okay, we got to figure out some plan B, some better plan B, because this could happen again. So what I did for the next 9 months, I looked for another bank job, but my longer term plan was I've got to figure out some other business that will allow me to retire faster, because if I just stay on the corporate track, it's going to happen again. Layoffs are going to happen again. It's kind of a fact of life in the oil and gas space. So the day I got into my next bank job was October of 17. I was already planning for the day that I was going to exit, and that day was February of 2020. So I knew real estate was the way to go. I just didn't know how to get there. So what I did was I bought a little fourplex as an IRO in March of 18, and then just worked my bank job for another 2 years, and then just pulled the ripcord in February of 2020 and joined Lifestyles just thereafter.
Okay, so you joined February 2020. How did you hear about Lifestyles?
Through friends.
Through friends, okay.
Yep. A buddy of mine, Gabe from church, I was telling him what I had planned to do, and he said, oh, I know a guy who's doing that, and why don't you talk to him? So that's when I made a phone call to John Whitaker. I think he's here in the crowd tonight. John, raise your hand. Yeah. So I talked to John for about an hour and a half on the phone, and he suggested I come to the weekend seminar, and I did. And And then I called him back and I said, is this a scam? and he said, no, it's not a scam. It's going to sound like that. You might sound like that, but it's not. And remember, at this point, I had already quit my job, so I didn't have a plan B. I kind of made the jump. But I knew I was going to do this, so I thought, okay, you know what? You got to take the risk. You got to lean in. Yeah, so first it started with a conversation with John, came to the Weekender, called John back, and then wrote the check.
I mean, it's a lot easier when you have someone that you know that's already done it, right? And that was the same kind of situation with me. I got into lifestyles because of a really good friend of mine joined 2 years prior. So that coming here for the first time, even after talking to a good friend, he was like still questioning, is this real, right? He was already a believer of real estate. He kind of had an idea what he wanted to do. He jumped into the fourplex, which are not an IRO, it's single family, sorry. Sorry.
I learned a lot of hard lessons trying to do it myself.
But the cool thing with the fourplex is, I would say a good number of very successful multifamily are folks that jumped into single family first.
Yeah.
So, I mean, that seems a very consistent story. Okay, so, all right, so you joined in February of 2020. Perfect time, right? It's a great year. Best year ever.
I was in the last weekend seminar in person, in
Last
this room,
weekend
in this
seminar in
room,
person.
and then everything went virtual.
Oh, that was when I taught, right?
Wow.
That was when David Fisher
Yeah.
taught. You remember, I was sitting way in the back.
Yeah,
with
you're a
my hands
skeptic.
crossed.
Yeah, you're full of crap, I think it was.
I didn't say that. I might have been thinking it.
Okay, so February of 2020, and then how long did it take you to find and buy this one? When was the first time you actually, like,
Step foot on the property, or
yeah, like property tour from the time you joined, February 2020?
yeah. So I think it was late February 2020. I joined. I got a call from a broker in mid-August. So probably about 5 months. But I was underwriting a lot of deals. I was looking at a lot of things, and then I got a call for this one in Huntsville. I was looking much closer to Houston, but I just wasn't finding any value because prices were still a little bit elevated at the time. So as Dave teaches, to find value, just go out to secondary and tertiary markets. So Huntsville, for those of you who don't know, it's about an hour, a little more than an hour drive north of Houston.
Yeah, we're speaking to a national audience. We have Houston, greater Houston area, then we have the Woodlands, we have Conroe, we have Willis, and we have Huntsville. So basically that's where we're talking about is north of the Woodlands, very far north of Houston. I wanted to bring up the time that he joined and talk about when he first entered this possible acquisition, because within the multifamily side of things, the closing process is several months. Like from the time that you analyze a deal and you submit an offer and you go under contract and then you go in feasibility and then you go to close, we're talking, it could be 3 or 4 months. 3 or 4 months. So to see November and give him a hard time that it took him that long to buy a property, the reality is it was about 5 months, which is a pretty good pace in the world of multifamily.
Especially for never doing it before.
And doing it in the middle of COVID, for crying out loud, right? I mean, when you think about fear, we all have the fear of taking that first step into doing something new, this world of real estate. That fear part, he's also now facing this fear of unknown, uncertainty in this world that's gone crazy with COVID and lockdowns. So talk about that a little bit. I mean, was there any doubt?
There was a lot of doubt.
Right? Okay, it wasn't.
There was a lot of doubt.
It wasn't like an easy decision.
It wasn't, and you remember. I mean, you were my mentor on this deal. I agonized over every little detail because I was, I had the MFQA, and Dave will talk about that. That's our spreadsheet on how to analyze these deals. And being a former, bank underwriter, I drilled down on every number, and I just got lost in the weeds. But once we went out and walked the property and looked at the surrounding area, that's when the kind of the real estate part of you kicks in and you realize like this, If the numbers pencil, everything else like that you can see and touch, it feels right. And then you're in diligence period in your contract, and then you get to inspect everything. It just, everything, I just felt like we were getting, signs at every step of the way that we were on the right path.
As a mentor, we're not going to say, let me rephrase it another way. Sometimes my job as a mentor is to push somebody over the cliff to do the deal, right? Because of the fear that's involved, the numbers, uncertainty, the doubt. One of the benefits of being a mentor is I get to go into submarkets that I normally wouldn't go into. And so I've visited Huntsville for other members. I've done feasibility in Huntsville 3 or 4 times already, and aggregate time frames to where I've noticed all this new construction that's happening in Huntsville. And I was always amazed every time I had to go back, because it's almost an hour and a half drive from where I live in Houston to get to Huntsville. I'm like, wow, there's just a lot of things happening. So I became very familiar with this submarket. And when I saw this deal, I knew in my mind that I was going to be the one pushing the member off the ledge to buy. There are some other deals where I'm looking at, because I know the same knowledge, but it's not positive, I'm having to hold them back and not do the deal, right? So in this case, this was one of those deals. I don't think I said it to him, but this is what David would say to his members: if you don't buy it, I'm going to buy it. It was one of those kind of deals that I had in my mind. I don't know if I actually said that to you, but I had that in my mind. If you're not going to buy it, I'm going to buy it. All right, so talk about the numbers.
Okay, so this is this is a classic garden-style apartment complex, 32 units, kind of shaped around a courtyard, horseshoe shape, built in '65. As we talked about, we bought it we closed early November of 2020. We got it at $38.5 a door, and at the time, I think I was telling y'all that we were looking originally at deals in Houston, and they were in the 70s, 80s, 90s, and I just couldn't make the math work. And so we pushed out to the secondary markets, and we found this little gem. And yeah, we got it under contract in early September. So we raised $750,000 of equity, and we got a bank loan, a little over $1 million, full recourse. And we had a rehab budget that actually...
Whoa. A lot of people in this room don't have $750,000 by themselves. Can you break that down for us?
Yeah, thanks, David. So we syndicated. We brought in 12 partners, passive investors. As a first-time lead, I was required to put in a minimum of 15% of the equity capital raise. So I had a little over $100,000 of my own money, my kids' college fund, might I add. This is no joke. That was their money.
Do you see that pushing?
So, yeah, the joke was whenever I had to go visit the property, I was going to the big college fund, which is what it was. So, yeah, the 750, that was a syndicated equity raise. That was myself and 12 other investors through Lifestyles.
So can I ask you a couple follow-up questions real quick? Because we have people watching from all across America. Were all your investors from right here in Houston, or were they out of the area at all?
Most of them were from here in Houston, but we also had folks from Georgia. We had folks from North Carolina. North Carolina and Georgia.
So the reason I bring that up, when you come to my seminar this weekend, I have folks from all across America watching. You don't have to live next to the property. Live where you want to live, invest where it makes sense. So if it's a good deal and good numbers, you can be living in Hawaii and own part of this apartment. So you have 12 different investors, all different walks of life, all across America. Now here's a further follow-up question. How many of those 12 investors walked the property with you?
One.
See that? Who likes that idea? Just mailbox
two.
money. That's the only reason I'm bringing this up. So you don't have to be from that area.
I was one of those two.
Yeah.
Oh, you're one of them. Okay.
Sorry. I told you it was one of those, if you
One
don't buy it,
of
I'll
the people
buy
was
it.
Curtis.
So if I couldn't buy it, I'm going to invest as a passive in the deal. Yeah.
So, David, further to your point, of the people that invested, yeah, 2 were from out of state, but on my passive distribution list, I probably had dozens of folks from out of state, California, Oregon, Colorado, all over.
What was your lowest investor in this deal?
25,000.
So folks, people always ask me, in a smaller deal like this, we always tell guys, save some slots for new people, 25K. So you don't have to be a multimillionaire to do this. You understand? It takes money to make money, but people invest as low as 25K in a deal. Okay.
Yeah, we had a couple of the investors that this was their very first deal.
Oh, and really quick, everybody give him a hand for helping out the little guy.
Yep. Okay, let's go into numbers.
Okay, these were the numbers we went into contract with. So on a trailing 12, March 22, we had 254 of income, 113 of expenses. We were cash flowing about 7,400 a month, and our T12 NOI was 141. When we took over the property in November of 2020, it was just over 100,000. So there were a lot of pockets of value increase that we were able to tap in. This deal just had a lot of classic, kind of value add opportunities to boost the revenue, cut the expenses, and boost the NOI.
Yeah, David's going to teach you 32. Is there 32 or 34 ways to improve on?
It's like 28.
No, I thought it was in the 30s now.
There are more, but we didn't update the list, so I'm still saying
so
28.
There's 28 ways to improve on the income line, and there's ways that we can improve on the expense line. As a result, he was able to increase the NOI from 100,000 to 140,000. David will also teach you in the 2-day the impact of what that increase in NOI does to the value. And that goes directly to the bottom line on the value.
Do you know how I could tell he was a banker? He doesn't round numbers and $4. But you know what? I could tell he's not an engineer. Where's an engineer in the room? You wanted to say 0.65, don't you?
That's funny.
So just rounding out the slide a little bit. So our last month that we recorded figures for, we were doing almost 12% cash on cash return annualized for the equity amount that we raised. So 74 a month. That 12%, not bad, right? And then we did one distribution in February of 2022, about almost $69,000, and that equated to about a 9% return of capital. And then the sale valuation, that's actually, we went into contract at 2.46. And remember, we bought the property for 1.2, and we put a little over 600 into it. So it's pretty good.
And we're going to cover more of the actual gains in a second. So let's go ahead and jump into some before and afters, so you can kind of see what he did.
Oh yeah. This was fun. What you're looking at on the left, that was my first skip rent. We went in to this unit. That was unit 106. The people that were living there weren't even on the lease, and they promised to pay me 3 times.
Purple Martian. So
This
is normal. You, as part of the acquisition and multifamily, we plan ahead. In terms of cash flow, we're going to have a transition. It's going to go from 90% occupied to down to a certain 70% up. We're not going to panic, and we have to go through and weed out what David's going to kind of clarify as purple Martians.
Or we call them financially disenfranchised individuals that don't pay rent.
Okay, that's probably better.
I want to be politically correct.
Okay.
I wouldn't be so diplomatic. Anyway, yeah, we got these folks out, and then we started renovating, and what you're seeing on the right is kind of the after show. In the kitchen, we went in and refaced the cabinets, new appliances, resurfaced countertops, new dishwasher. We did vinyl plank flooring throughout the entire unit. The same formula as far as paint colors go. We had a silver point gray and with white trim, and new light fixtures. I think we put a new fan in the living room too. This had a pool view, so I think we bumped rent on this one about probably, I want to say 150 or 175.
It looks really nice, doesn't it? This is a pretty standard, give me a hand. This is a pretty standard make ready. He did not put granite countertops, right? He did not put granite countertops. He did not put real hardwood flooring, but it looks gorgeous, and it's going to have it to be able to handle the wear and tear that you typically get in apartments. Okay.
All right, this is when the fun really begins. So this complex was owned by the previous owner for a little over 8 years, and it suffered from lots and lots and lots of neglect, a lot of deferred maintenance, which, again, I think that's one of the driving reasons why we got it at the price we did. If you look at the top left corner of this slide, you see the retaining wall and that old elm tree butting up against it. The retaining wall was 6 feet from the grass, and it was basically crumbling. It was failing because the elm tree was just crushing it. So first thing we did was we blasted out that corner of retaining wall and put a bend in it around the elm tree. And then this is the real good one. The top center, you see that support post that's it looks like it's touching that concrete footer. It's not. There's an inch gap between that concrete footer. So basically you've got these balconies that are not supported. There's about, I want to say 26 or 28 support posts, and many of them were not even touching the concrete footers. So we bought a complex that had an open permit with the city to fix the balconies, and I believe, I'm speculating here, the previous owner, when he got the estimates to do that work, he just thought, nah, I don't want too much of a headache, too much money, time to sell. So that's part of the reason this deal came to us. So we had a permit we had to extend and get rebid to fix all of those concrete footers. There was tons of wood rot in the soffits and the fascia, as you see in that top right picture. The roofs were actually replaced about 1.5 years before we bought it, but before then it was leaking for many years. So there was a lot of hidden wood rot and damage when we peeled back those plywood pieces. Pretty much the same picture in the bottom right, just all the work that was being, that we were opening up to be done on the soffit and fascia. Now, the bottom left, I want to draw your attention to. This was the major capital item here. We scoped the lines, the sewer lines, during our diligence process, and we found significant structural damage. There was bellies, there was holes, some size of a coffee cup. So sewer lines are, they're nasty things, and they're underground, so you often don't see, how bad this is. So we were able to negotiate a pretty substantial discount from the seller because of the conditions of the sewer lines, and we raised a little bit more capital, and we upped our CapEx budget for full replacement. We weren't sure. We talked to the investors beforehand. We weren't sure we were actually going to do it. We wanted to just have the just-in-case capital budget in case we wanted to do it. And we discovered probably 3 or 4 months in that we were having backup issues with the sewer lines. So we said, okay, let's just go ahead and get it done. So that's all the before. So we inherited a really huge project. The after pictures, the first thing we did, the first dollars we spent on CapEx is we trimmed down all the bushes. A lot of it was overgrown up to 10 feet. We limbed up the trees. We started replacing that retaining wall and sections of the sidewalk. And if you look at the lower left-hand picture, you see that little kind of that little concrete cylinder coming out of the ground. Those are all the new footers that we poured. Those are going down 3.5 feet. So we did that for all the support posts.
Imagine that, support posts.
Yeah, that's kind of a life safety issue.
And the thing with all the stuff was uncovered starting with the property tour. So when he did the property tour, he started making notes of, okay, there's some issues here. When we went under feasibility, he had general contractors come in and give him bids and all this. So when he actually goes to close, there's not these surprises. Right, so when we look under the hood, it's like, ooh, we've got a sewer line issue, we got support issue, right? At the same time, he's also like thinking about curb appeal. How can I add to the property? What can I do as far as amenities? And he's taking in all this information, talking to other members, talking to mentors, talking to the consultants and operation consultants, and really coming up with his game plan so that he has enough rehab budget to address all these issues. So a lot of this may seem like overwhelming in terms of the type of work that he's doing, and the next one's pretty cool too in terms of what he's done with the property, in terms of adding an extra amenity for the residents. But I want to just emphasize that all that work was done prior to closing, and none of this was a surprise, right? So, okay, well, I'll stop.
Yeah, no, that's good. I mean, we saw we knew what we were getting into, and we had a 3-week feasibility period, so we were able to de-risk it, really plan and budget for all the work, the scope of work that needed to be done, with some additional funds and contingency as well, because you always run into some surprises in older properties. Under the wait, there's more category. There's an kind of an old abandoned storage room you see here in the lower left. It was just kind of dead space, and we thought, okay, that would be a really nice office. So that's what we did. And you can also see that there was a kind of a janky old hurricane fence that starts at the old storage space, but it goes all the way around the pool. And back to this whole curb appeal idea, nothing says janky more than an old hurricane fence around the pool. So we replaced that right away. And then we redid the facade of the laundry room and the office. And then the pictures on the right, you can see actually that's the new office where the old storage room used to be.
I can't remember. So this property did not have a leasing office?
Did not have a leasing office.
A lot of times when we're looking at properties that are like 50 units or less, what they'll do is they'll take a unit and make that an office, leasing office. So you're basically having a down unit. And sometimes, or a lot of times, members can come up with some creative ways like this to basically move the leasing office into another space so that now they have actual rentable income coming in. So,
And this weekend, you'll see how powerful the numbers are behind that. So.
All right. Wait a second, I see projections. What's going on here?
I'm a banker. I have to have projections. And we have to syndicate the equity, so people want to see what they're getting into. So we.
So this was the original projections,
Yep.
Year 1, year 2, year 3.
Yep.
And then the next slide, we're going to show actual.
Correct.
Okay, got it.
Correct.
Is every nerd in the room happy with all the numbers? Okay.
They're reasonable.
No, they're great.
All right, so without going line by line,
Yeah.
Year 1, year 2, year 3, you're looking at anywhere from 6 to 8% cash on cash, right? So year 2, year 3, 6 to 7%. Let's look at what actually happened.
Okay, so we purchased it at 1.23. NOI was a little over 100. Year 1, we actually ended about 130 because again, we found we tapped most, if not all, of the revenue pockets to extract more revenue out of the property, make it perform better. But we also whittled down expenses too, so that all showed up in the NOI line. So actually, if you want to back up one slide, so our first year projection on NOI was 111. That was an 11% increase, and we had a 30% increase.
So you went from 111 to about 130 for year 1. Year 2, you're projecting 126, and you ended up hitting 141.
Well, and the year 2 is kind of misleading because that was actually
These are nerds
March.
talking, by the way. You get that?
that was March. That was 3 months into year 2.
Yeah. So you're
Year 1 point.
annualized.
Who likes the
Annualized.
fact that he was conservative and he underpromised and overperformed? Who likes that? Because that's what we teach from a conservative point of view.
Now, did you see anywhere here he was planning to sell in year 2? No, right? So what happened?
Offer I couldn't refuse.
Well, but what else happened?
Well,
What about that drive?
yeah, okay. So 32 units. I was managing everything myself.
Right.
Small property. Small properties don't have the budget really for a full-time leasing consultant, property manager, asset manager, full-time handyman. I was wearing a lot of hats and I was putting a lot of mileage on my car.
And I want to emphasize this because this is a very different distinction than you hear on the single-family side, where it's like, how much time do you spend? And you hear on the IRO side, when I say independent rental owner, how much time do you spend on the property, right? It's like, David makes fun of it because you're really not spending much time on the property. As a lead who has a fiduciary responsibility for other people's money, this is a full-time gig. This is not living the lifestyle. This is hard work because he wants to take care of other people's money. I just want to really emphasize that because this is not for everybody to step into a lead role, because you can't take it, as something that's like simple and easy and I'm going to be able to live the lifestyle being a lead. No, when you step into a lead role, it's a lot of hard work, it's a lot of pressure, it's a lot of stress, right? But you're well rewarded for it. And I just want to emphasize that, yes, he got a fantastic offer. That was really the main reason why he hit his year 4, probably, projections. What was the...
I think it was in excess.
5?
Actually, let's back up one slide. I was in excess of my year 3 projections within 18 months.
Yeah, so it was like, okay, I hit my number. I hate the drive. And so he went to his investors and said, hey, here's an unsolicited offer. Here's the estimates of the returns that we're going to get. What's your vote? And obviously, we all voted yes.
It was unanimous.
It was unanimous. All right, so, did I miss it? So what was the return? Yeah,
okay. So the returns. So 574, that includes the 68 that we already paid out. So on top of the 750 that we gave back, it was a little over it was about $505,000 of profit that was distributed to the members.
77% return.
A little over a year and a half.
Yeah, a little over a year and a half. Who would like that?
Who'd be okay with that? Now, yeah, one thing
Use
really
more
quick.
hands.
I love what he said. This is a full-time job for the lead. He did all this work. Now, there were some lazy passives in the deal that did nothing. All they did was get a check. Are any of your investors in the room, really quick?
Yes.
I'm in here.
I
And who else?
see.
Anybody else in this deal?
Sorry. We got 4 in here.
Okay, so you got 4 people. They all raised their hand. How much work did you all do on the property? Zero. There you go. I just want to make sure the people watching know, as a passive, you do nothing. He's doing all the work. Okay? And you got the same return. So.
They cashed checks and maybe read reports.
Yeah, that's a good way to put it.
Maybe.
All right. So what else on this? Anything else, David? Did we miss on this?
I just want to make sure people know they got all their money back plus an additional.
Yes, this was the $750,000. That was the original investment returned. On top of that, we got $574,000. So that's the 77% profit or 177% return of investment.
So I'll explain in round numbers so everybody understands. Let's say you put 10 grand in the deal. You got your 10 grand back, and then another 7,700 on top of that. Everybody follow me? Simple math.
Yep, like that. All right. How did you increase NOI?
Follow the roadmap, and this is what we learn in leads training. Just hit all the buckets you can. When we took over, we talked to all the residents. We said, look, we're gonna be doing a major renovation here. Rents are going up. So on the renewals for classic units, the people that wanted to stay but without renovations, they went up 5 to 8%. The newly renovated units, they went up anywhere from 12 to 20%. The previous owner did not have a RUBS. I don't know if you guys have talked about RUBS yet, but basically you're billing back water, electricity that's common to the property, natural gas for the boiler. We started charging the 1-bedrooms 15, we started at 10 for the 1-bedrooms and 15 for the 2s, and in the second season we went to 15 and 20. So that was about $480 a month that was, recaptured. So, that's over $5,000 a year. Like, we added value just by implementing RUBS. And then we burned off the loss to lease because the rents on this property before we took over were about 15% below market. So it was underperforming because the previous ownership didn't really maintain it well. They kept rents low just to keep occupancy high. So as we started truing up those rents to market, the loss to lease line item shrank. We also enforced late fees, right? I mean, there were a lot of late payers, and I don't think the previous owners were they weren't following up enough. So we started enforcing late fees and lease termination fees for people that wanted out of their leases. Well, you got to pay for that. That's not, we're going to incur turnover costs when they leave prematurely. So we started charging 2.5 months, which is industry standard. Non-refundable pet fees. Pets are precious. Residents want to keep their pets. Well, previous owners were charging, I want to say 100 to 150. We charged 2 to 250, depending on the size of the pet. So we were able to capture more revenue there. Risk fees. We examined every application to lease with us, and we understand sometimes there's, a hiccup in credit. People need second chances. Well, you got to pay for that. That's a risk fee. That's $250, non-refundable. We also put, now on the expense side, what we did every time we turned a unit, we'd put in low flow shower heads, low flow flush toilets, aerators on the faucets to save more on our water expenses. We called the city of Huntsville and told them to reduce our trash pickup time from 3 times a week to 2 times a week, save us $150 a month. That drops to the bottom line. We outsourced the contract, the maintenance and repairs. Previously, there was a full-time handyman on this property. There was, I want to say, 25 to 30 hours of maintenance being billed to this property, but he was working on other properties in town. So we just outsourced everything. I think we were spending about somewhere between $10,000 and $12,000 on a kind of a trailing 12 basis, where previously it was like, 30. And then last but not least, and this I think this is important because a lot of times these older properties come with contracts in the in the laundry room. So there's companies out there that, have 10-year contracts that renew in the last year. And this contract that we inherited renewed in 2018. So in theory, we couldn't get out until 2028. Well, I just called up the company and said, hey, our machines are breaking down every week. Residents aren't using them. We want new machines. And they said, okay. So they gave us, well, they're not new, they're refurbished. But when they went in there after the renovation, usage went up, revenue went up, royalty income went up. So awesome. We hit as many buckets as possible.
Now, if you're new, everything sounded like Greek to you and you don't understand, I will break all that down this weekend. In the simple language, you'll understand that. You don't need to know all that now. In the end, all you had heard was we made a 77% return in 2 years for the new people.
All right. Okay. So how has this changed your life since joining Lifestyles?
Well, I'm in control. I mean, I don't have to just, see money flow out of my paycheck after taxes every 2 weeks into an account that, may churn my stomach when I see a market drop in a day. But really that I can't access and I don't have any control over because that money's locked away. Like if you try to take it out, they're going to hit you with a tax. You might have some investment discretion, but you can't touch it for 30 years. I wanted control of it. And I feel like on this path, I can get there a lot faster doing it this way.
What's next? Short-term, long-term goals.
Okay, so I'm actively looking for deal number 2 right now for those passives that are looking to get on a list. And I'm looking to acquire, I'm sizing it between 100 and 150 units, which will likely involve an equity raise somewhere in between 3 and 5 million. I'm just starting to live the lifestyle. I'm in between deals right now and I'm living the lifestyle. I'm spending more time with my kids. I'm coaching Little League. I'm planning a sailing trip to the Caribbean in the spring. It was fun work. It was hard work on the first deal, but it was immensely rewarding, and I want to do it again. But I want to, take a little bit more time off.
Long term?
Long term, yeah. So, we don't need much. I say we. I don't need much, but I think we'd like to have, my family and I, I think 1,000 doors plus is probably the right number. Once we build up a management company, to have, professional folks overseeing it. So we just, manage managers. And then I also want to start investing more and more passively with, younger aspiring leads that are coming up.
Someone else doing all the work? Have someone else do all the work?
Yeah. But also, I can impart experience that I had on my first deal, and I know I've got more lessons to learn on the other deals too. But everybody's got a first deal, right? Whether you're investing or you're owning and managing and operating, everyone's got a first deal. So the experience that the mentors have shared with me, like I want to give back and I want to share with others too. So I want to start investing passively with more leads, and then just continue to expand the network. And at some point, just sit back and go to the mailbox and collect checks.
I like that plan. So who's on your team?
Well, Curtis. Curtis talked me off the ledge several times.
I pushed you off the ledge.
Yeah, push me off the ledge. Yeah, Curtis. Official mentors, Curtis, of course. I do need to give a shout out to, unofficial mentors. I do want to mention John Whitaker again, a lead, currently out of Texas City, acquiring more properties. I talked to John, many times over the ownership period of this asset, just asking for operational advice and just very, very helpful. And then I also want to mention Manoj Krishan. He was one of my passive investors. Again, spent many hours on the phone with him, talking through debt financing, market structuring, and also, what do you look for in terms of as a passive? How am I communicating effectively with my passives? And then on the realty side, Diana Mon and Diana Bryan, indispensable, helping out with, valuations and, just the whole process of multifamily. And then vendors, Richard Copeland in the back. Richard brought me, I want to say it was 3 or 4 finance options on the front end, and eventually connected me with Citibank, who gave me that recourse loan, which they were happy to have paid off, but they were sorry to lose a client. And then Benchmark Insurance, Javar and Haytham Fudi, they underwrote the GL and the property policies for me. And there was one other shout out. Just there was a lot of folks who helped along the way. In secondary and tertiary markets, you've got a lot of smaller trades and contractors who I just couldn't have survived without. I mean, on older assets, there's plumbing issues, there's HVAC issues. So, huge shout out to Drainco in Huntsville, EC Heating, Deline Zender of Zen Real Estate, Jack Wagman, also of Zen Real Estate, other property owners around there. I also want to give a shout out to the other lifestyles owners in Huntsville. Huntsville's, a small but growing market, and there were a handful of people that I reached out to, on a regular basis to just, swap experience and stories with, and also lean on for help too, because, in smaller markets, your network is what is going to, get you through it. And it's good that Lifestyles has a good presence up there to get through. So, yeah.
All right.
It's a team sport. Real estate investing is a team sport for sure.
You get that idea now in terms of how we interact with each other and how we're helping each other. So let's give Scott a big hand. Open up for some questions. Questions for Scott? It's a lot of information, I know. Sorry to get too detailed on the numbers.
Passive investor, investor wants to get out before you sell. What happens?
So the question was, what if a passive investor wants to get out of the deal mid-deal?
Yeah, so in general, as these syndications are not publicly traded stock or highly liquid, so it's when you're going to make an investment as a passive, you want to think of it as seeing it through the end. But we all have life events that happen. Sometimes they're bad life events to where you actually need the cash sooner than you expect. And so on occasion, what happens when that situation occurs, you just go to the lead and say, hey, I need my money sooner than later. I would like to sell. The lead would send out an email to the current roster of investors and say, hey, we've got a member that needs to sell. Anybody interested? And we go from there.
Yeah, now watch this. How many people, knowing with his projections, let's say we're 6 months into the deal, would buy out the other guy's shares? It's easy to find other people. It does happen. People get cancer, their kids, something happened, emergency, things happen. It's happened.
Yeah.
Divorce?
Okay, there we go.
Hey, in divorce, it's cheaper to keep her.
Question in the back there.
So I'm not a numbers person, but as I came in here thinking you would make more money investing in an apartment complex if you're a small investor, or what?
Passive investor.
Or well, I'm just saying if you put in a smaller amount, how you said you leave slots for smaller investors. But it seems like when I was looking at the numbers on the single family homes that they make more faster.
There's different returns on every deal. We show whatever comes that night. There's some deals that make less, some deals that make more. But here's the question. How much work did these investors do in this deal that were passive?
Right. So is that the main difference if you go into as a smaller investor?
Here's a lot of people don't understand this, and that's why it takes me 2 days to teach all this. In the goal in the end is to buy back our what?
Time.
So if I could put 100 grand in a deal, do no work, and double it in 2 years with no involvement, or I can buy a house, make phone calls, deal with realtors, deal with contractors, see your time. You can make good money on houses, maybe 50 grand a year. Would you like to make $500,000 a year? You can't do that in houses.
Okay.
I made about $1 million in the past month through my deals. I could have never done that in houses. Does that make sense?
Yeah. Okay.
So it's a scaling thing, and that's why I said, if you remember when I taught that continuum earlier, single family's great. It's like being self-employed, but you still have to invest time.
Yeah. Okay. Thank you.
It's about buying back your time. Great question, though.
And,
Yeah, I'd say in my experience, your money moves a lot faster in apartments, in my view.
and I,
Employ bigger amounts.
And I'll just say one more thing too, is like you have a chance to sit down with a mentor and you'll be able to really understand your financial background, where your starting point is, what your short-term, long-term goals, and we can help guide you. What makes the most sense. Right now, it's kind of hard to figure out, but we'd walk you through that.
Yeah, when you go through the seminar, I break it down. Where should you start based on your financial position? If you have this amount, you do this. You have this amount to do that. So we guide you through that process. It's a great question.
So you said earlier that when he was offered the deal to sell early, that he would go to the investors and say, I received an offer, an unsolicited offer to sell. Is that an important distinction as a lead?
So the question, so you heard a question. It's only important in the sense of if he was going to officially put it on the market, he would have asked the passive investors for permission first. So if he's going to actually officially sell it, he needs to get the passives to say, yeah, we want to sell it. So when I said unsolicited offer, it's basically saying he wasn't planning on selling it. He hasn't got the votes yet to officially sell it, and that's why he had to reach out at the time to get the votes.
So the power of this is really, when you think about it, is
Go ahead, that's fine.
if you're in a mutual fund, it is what it is. You have no voting, you have no choices. Here you have control of your money. It's about being in control. So
Relative to your investment.
right,
to
yeah,
be
relative to your
fair,
investment.
investment ownership, right.
I have a question. I have two questions. One is about the unsolicited offer. Did you know that? How did that come to be? And how did you get the unsolicited offer?
Yeah, so we it came in from another Lifestyles member, and they lived up in Montgomery County, which is just north of Houston, so they were familiar with that market, and they were aspiring leads at the time, and they reached out to me. I think they actually talked to Curtis first, and then reached out to me and just said, "Hey, would you ever consider selling?" And the answer is possibly, right? And then they said, "Well, we would be interested in buying." So reached out to the brokers and said, "Okay, what do you think this is worth?" And so what we got BOV, which is called a broker's opinion of value, which is what it would fetch on the market if it was sold today. And then we went back to these folks and said, okay, well, we think it's worth this, and what are you prepared to offer? And it was a very informal discussion, and I think it took probably a month to kind of go from initial discussions to actually getting a contract.
So we had another aspiring lead that was actively looking, and they, because of where they lived, was very focused on a very specific location. And so you mentioned there's other owner-operators that are in that area, so I'm sure they reached out to all the owner-operators in that area. This guy was traveling almost 2 hours or 3 hours round trip every other day, right? And so he caught him at a point in time. Was like, oh, well, maybe I can sell early, but at what price? So he went and got a independent opinion from a broker, an outside broker. And did you get 1, 2, or 3 different opinions, or
Actually, 4.
4? So he got 4 different brokers of opinion and value, came up with what the true value of the property was, and said, okay. And then they negotiated with the Lifestyles member on price.
Now, here's something you probably was a follow-up. Well, why would that person want to buy it? And I understand your logic, but there's something called the economies of scale. This was his training wheels. His first deal, it's only 30 units. He can't afford staff yet. He wants to go to 100 unit, but he had to learn. This new guy never did it before. Well, what better to buy an asset that's already stabilized, it's all running well, leave a little bit of meat on the bone for me and my investors, I'll learn on it. And guess what? That guy will sell it to the next guy. So sometimes you'll go up here and Curtis will go, this is a 4th generation Lifestyles member. In other words, this guy made 100%, this guy made 100%, this guy made 80%, this guy made 100%. And that's what happens here, Lifestyles, because the 30 unit guys going to 50 units, to 100 units, to 200 units plus. Does that make sense? So there's always meat on the bone for the next guy, and real estate makes money in up or down economy. If you can make a 6-8% return, that's great.
And typically what happens too is when you reach out to brokers and say, hey, I want a BOV, they're also bringing in other potential buyers. And so a lot of times we'll now have 2 or 3 buyers for this property. And this happened on another deal where the Lifestyles owner picked a Lifestyles member during a very heated best and final process, because it, just like this property, was in an extremely solid location, middle school right across the street, new Class A built right next door in a fantastic submarket that's growing. So it was a very hot area with lots of offers. They chose the Lifestyles member because they wanted to give back and to give that person an opportunity. I don't know if you had other buyers being drummed up at the time. Did you have any other
Well, as part of
offers?
the BOV process, what the brokers are really doing is they're trying to get the listing, right? So they're telling you, oh yeah, you're going to sell this thing. It's going to be easy, slam dunk. Which, I mean, we all know that if you get enough BOVs and you know your business well enough, you know what the value of it is. And if you've got and you're motivated to sell, and you get a good, solid, reasonable offer with a high percentage of closing, this is just my view. Life's too short. Just move on. Leave some meat on the bone. I renovated 2/3 of the units. There was 1/3 left for the next owner, and I'm a big believer in everybody's got to have a first deal, right? So I talked to the buyers, and we got to know one another, and I thought they're the ideal folks because they live close by. They're trying to get their first deal. I'm giving back. They still have plenty of upside left in that deal. So I think everybody won on that trade.
My second question is more personal. Do you have to, from this deal to the next deal, still create active income for yourself? Or are you able to kind of live the lifestyle?
Good question. So, who's on my team? God first. I want to make sure I mention that because people need to understand. I take my faith very seriously. I couldn't have done any of this without the Lord's help. Number 2, my wife. I mean, so she's still working a corporate.
She's still the sugar mama.
She's still the sugar mama. Still working the W-2 job. And we talked about this for a long time. And back to the original part of my story, we planned for 2.5 years for this project to happen. So we talked about it. I mean, the day the last paycheck hit my account, she called me at my desk and said, okay, it's in the account, you can leave now. So she was on board 100%. So please give a round of applause for my loving wife. And that's important. I mean, because until you get to a certain scale with multifamily, you you do need an external source of income. So my wife is lovingly and graciously providing all that for us right now.
Yeah, he is not getting rich off this first deal. This is
No.
proving himself, skin in the game, hard work. As he gets bigger, he'll make more money, but you have to prove yourself with these people.
Wait a second. He got a 77%.
Well, you know what I mean.
Tough crowd.
Tough crowd, right?
77%. The bar's pretty high now.
So you're going to go to Stanford now instead of local school? Is that the college fund?
Yeah, the college fund. Yeah, no, we're hoping for UT. Yeah, no, the lifestyle will come, and now we have proof of concept. You know, I cut my teeth on this first deal, and now we scale up. So it's the roadmap's there, and that's the thing. I mean,
Confidence, just everything's there.
listen to your mentors.
Can I ask you a question? So there's some new folks here coming to the seminar for the first time. Remember back when you first came, you were skeptical. I remember that. You were like this in the back of the room. What advice would you give to the new people coming to my seminar this weekend? What would, because we all have these preconceived things.
Yeah.
What would you give them to overcome their fears and whatnot? What would you explain to them?
Well, first of all, anybody can do it. You just have to trust that this is a real thing, right? And look, I get it. It sounds too good to be true. A lot of times, just listen, absorb it, sink in. Talk to people. Talk to people. Talk to people that have done it. Talk to other people in the audience. Just talk to folks. This is what it is. It is what we say it is. So and ask the mentors. I mean, they'll tell you, yeah, real estate investing is a team sport. There's a whole suite of people here to help you do it. So there was a point where I thought, I want to just do this alone. I don't want to have to pay any money to do it. That would have taken me 5 years. So in the long run, the membership is like, it's a drop in the bucket.
When you call the other owner-operators in the area, did they not give you like real good, intelligent information?
Really giving of their time.
Financials, how much does it cost for this? Whatever you ask, that part of giving back. Think about any other business that you start. How strange that would be if you're trying to open up a restaurant and you're calling your competitor across the street. Would they share all that detail with you? No. That's what makes lifestyle so unique, is that giving back part. So no matter where you are looking to buy, you can always reach out to somebody who's nearby, even if they're right across the street, and they're willing to share everything and anything. And even staff, too. They'll even say, hey, I got a maintenance guy that I can spare 8 hours a week to come help you.
So I guess just to finish up that point, just take the leap. Take the leap. I was in those chairs, 2.5 years ago, and if you've watched any other case studies, that's a common thread. I mean, we were all in those chairs at one point, and you've really just got to, there's always going to be a fear factor. Just take the leap.
Leap of faith.
There you go.
All right.
Awesome.
Do
Okay.
we have time for another question, or we're good?
Well, if we have any, make sure we
Online?
don't ignore the online. Joe
not-
Biden over there.
He's not even paying attention.
That's what he looks.
No, I don't have any questions over here.
You take a lot of heat this whole day.
Corn pop.
We work together.
I don't have all my answers ready for the Joe Biden thing. You kind of threw me on that. That's usually a Saturday morning
You
thing.
got one back
The,
there.
the passive investors, when they get the money, the first time money, not at the end of the deal, when they get that, they invest, let's say they invest the 25,000. When they get the check, does it involve tax or it is still not?
That's a great question. So when real estate's done correctly, which I'll break down this weekend, all of this passive income is what's called deferred taxes. So we don't have to pay any taxes on it. Each year you're going to get a K1, and the K1 is going to show us something called a passive loss. So you might have brought in 10 grand, but your passive loss will show 20 grand, which means to the IRS it looks like you're losing $10,000. You pay no taxes. Do you want to pay taxes, sir? Okay, you're a great American.
Depreciation on real assets is a real thing. It's a gift from God. Actually, the U.S. Congress.
Yeah,
God bless
and
America.
I'll break down how this works throughout the seminar.
But when it comes time to sell, there will be some taxes, but there are some strategies he'll go over how to defer that a little bit longer. Defer, and die is kind
Exactly, yeah, defer. And remember, it's not earned income, it's passive income. Capital gains rate is much lower than your earned income rate. So no matter what, it's still a good deal.
I do have a question over here now.
Okay, go ahead.
How would someone with a full-time job be able to be a lead for the first time?
The question was, why am I repeating it? You want to answer that one? You're a mentor.
Yeah, so it is possible. I'd mentioned that this is a full-time gig, that they need your full-time effort. It is possible that someone's working, has a W-2 job, can also be an aspiring lead, but there's specific conditions that must be met. They have to have the flexibility to have a side gig. If you have a corporate job that requires your undivided attention from 9 to 5, you can't do it.
Right.
You can't do it. So if you have a flexible job, especially nowadays with work from home,
Or consultants.
or consultants, salespeople, instead of getting on the golf course, hang out in an
Or
apartment.
if you're married and your wife's working full-time and sugar mama and you have the flexibility, there's got to be some give and take because you're a fiduciary for these people, so we want you to be dedicated to it.
Yeah.
As a passive, no restrictions, but as a lead, yes.
It's a good question.
It is.
Has it ever happened, or is it not unheard of for, say, a lead to put in 100,000 on something that's $1.5 million, and somebody else come in and put more than he does into the?
So the question was if, the lead puts 100 grand, but somebody else puts in $500,000 in a deal. Here's my rule that I recommend, and people get mad at me for this. I will never invest more money than the lead himself invests in his deal. That's my rule. I don't know how Curtis would address that. Probably doesn't agree with that, but that's how I do
No,
it.
that's a really good general guideline is don't invest more than the lead.
Right.
But if it's a
Yeah,
smoking,
the most
smoking hot
likely-
deal, then sometimes you have to. I don't know.
Yeah.
But
For
that's a
example,
good general rule.
the other year I mentioned in my speech earlier, I put 400 grand as a passive. Now, normally I wouldn't recommend that. You have more money to work with, but the lead also put 400 grand in that deal, so I felt comfortable that way. So that's just, I will not put more than the lead themselves. But
Yeah. Yep. We want the lead to have skin in the game. They're required on their first 3 deals to have skin in the game. On the 4th deal, they have a little bit more flexibility in how much, but then they know, wow, if I'm only going to put X dollars, most of the passives who are educated through lifestyles will not put any more than I put in. So I'm going to put in a bigger amount to make sure that that doesn't happen.
And we have rules here called suggested best practices, a white paper that explains all that, but I'll cover that in the seminar. Okay, cool.
I had 140,000 reasons to get out of bed every day.
There you go. Your child's college fund.
College funds.
You didn't want him going back to, the community college. Okay. So, cool. All right.
All right.
Let's give him a hand. Thank you so much.
Thanks, everybody.